In this video, I'm going to talk about, are you a greedy trader? Stay tuned. Hey traders, a very warm welcome to you. So if you watch Wall Street, I was going to say Wolf on Wall Street, but it's not Wolf on Wall Street. If you watch the original Wall Street, greed is good. Gordon Gekko, his famous kind of line that he spouts out. A lot of new traders talk about that. Are you a greedy trader? Is it good to be greedy? Kind of let's have a look and drill down into it. So I've drawn this scale, and if you're a subscriber, you're going to know how fantastic my drawings are on the whiteboard. Not really, fortunately, I'm a better trader than I am a drawer. A good time to mention, if you want to subscribe, consider doing so to see more amazing kind of pictures and doodles on the whiteboard from me. Anyway, let's get to the point. What am I trying to show here? Are you a greedy trader or not? You know that a lot of people say to you, and you've heard this all the time, yeah, you got to let your winners run, let your winners run, let your winners run. And someone says, hey, you can't be too greedy, or at least something on the table for the next guy, yada, yada, yada. You hear all that. But of course, what do? You know, you let your winners run, which is on this side. You kind of have to take some off and leave some for the next guy on this side. And so your scale is pushing back and forth. Where's your target going to be? Should it hit? Should it be here? Should it be here? Should it be here? You know, your market, you're long. Where should your target be? On one side, you've got this guy who says, oh, you got to let your trades run. It should be here. The other guy says, oh, you need to take some off the table. It's here. Where do you sit? And there's no easy answer to it. There's no simple, defined answer. All that we know, guys, is that you should be letting your trades run. You should be doing that. However, and this is the thing that a lot of people don't say, and there's always this big but with trading, and there's the however, there's this, there's that. You can't let your trades run when you're in conditions that aren't suited for that. Trust me, I've made this mistake many times, and I'll probably continue to do so, misjudging the conditions and trying to force your profit target onto the conditions. You know, if you're in a range-bound market that's kind of ranging over a week, or it's 300 points range, and you're buying and you're expecting to get a 300-point move, chances are not going to happen unless you're lucky enough to get right at the bottom and right at the top. You're not giving yourself the opportunity. You're not really you're kind of hoping for a breakout that hasn't happened. There's too many things have to go into play for you to get that 300-point move, for example. Whereas if you kind of said, okay, I've got a good entry here, I'm going to take 150, that becomes more meaningful. You've got no reason to expect in those conditions why you should look for, you know, extended moves. Because the market isn't in that environment. However, if the market is ripping off to the upside, pulling back, driving higher, range expansion, volatility, then yes, you go to this side of the scale and you say, let's put this here actually, hold and cut. So I'm going to put, you go to this side of the scale and you say, okay, yes, I'm going to hold my position because the market conditions are right. I'm in a good position. There's a fuel to the fire. Maybe there's external influence. Now I can kind of look, I can be greedy and look for those longer term things. Let the trade work in my favor. I'm in it. I'm in the cruise, so to speak. Let it mature. Let it pay me for being right. There's no reason to cut it. I'm right. I'm in it. There's going to be pullbacks. Sit with it, sit with it, sit with it. Stretch that muscle of trying to hold it for longer, hold it for longer, hold it for longer. The problem is, you then think, okay, I must do that. And then you try and force that into this environment where it's just not conducive for it. The market's too slow, it's range bound, it's very whippy, it's back and forth, or perhaps it's not range bound as such. If I can squeeze this in somewhere here, I'll put it in here. Perhaps it's very kind of wide channel based uptrend. So it's not aggressive like hugging a 5-period moving average or something. It's very wide based. And so you're in, but you're kind of looking for those longer moves, but you've got to sit through a lot of down move as well. And it's understanding the conditions that you're in, the market you're trading, what could affect the market further down the line. And that gives you a decision whether you should be holding and should be kind of stretching the greedy muscles, or whether you should be cutting and running and saying, listen, there's my target, it's very small, or it's relatively small. So I wouldn't recommend taking a very small target, but it's relatively small, and I'm out of it because, yes, it could go on. And this is the irony of trading, guys, isn't it? You've been there, I've been there. You're in a trade, you say, I'm going to take my quick 50 ticks, whatever it may be, bang, you take your trade off, and then that's the time it breaks out and goes on 300. So you say, oh, I must try and hold my trades longer. So the next trade comes out, you get your 52. So no, I'm going to hold it longer. I'm going to kind of go into the hold side of the scale now. I'm going to look to hold it. It comes back and stops you out. And you're like, and you get this back and forth, back and forth, back and forth. And it can become a little bit of a vicious cycle. You're trying to hold stuff, it's stopping you out. You're taking small profits, then you're seeing it going without you, and then you're out the trade for kind of weeks. It's finding that happy medium between the two. It's finding the kind of pivot point of the scale. So it's understanding that you look at the conditions, assess the conditions. When the conditions just historically are saying, hey, when we do good moves, we do kind of X% moves, or even if you've got a bit of a grubby chart. I'm going to kind of rub out my amazing scale drawing here because I want to show you this. Even if you've got a bit of a grubby chart, that will do. And I mean by grubby chart is, drive up, kind of push down, drive up, maybe push to highs. This is a normal chart for most things. It's all very well saying, well, if you're in a very, very steep uptrend, you do this, and if you're in an exactly range-bound environment, you do that. In the real world, we know that's not the case. If you're in this kind of chart, at least look at it and say, well, okay, what's the distance between that and that? Okay, that's kind of X%, so that's the kind of moves we get. What's the distance between now and that? What's the time period between that and that? Is there any pattern I can extrapolate from that or look into from that? If there is, maybe then if I'm going long here, I don't want to look for, my target doesn't have to be 10 times this, because historically we've had moves of X% that have then run out of steam. Is it going to continue like that? We just don't know in trading, but at least you're basing it on some fact and you're saying, well, if we are breaking out and this is kind of pushing to support, bad chart, but you get the idea, maybe I can use this as my target, however many points that is, and extrapolate that out up there and say, okay, that's my target, because just based on history, it makes no sense for me to be greedy and look for 3 times that, because it's just not likely to happen. Could you kind of take most of the trade off and leave a little trailer? Of course you could. But that's a separate strategy in itself. So anyway, the main summary of this, guys, is greed. Okay, we're not talking about greed as in greed. We're talking about greed as in wanting to get more from the trade, which is good because we want to make the trade pay us when we're being right. Assessing the conditions of it, only doing that when the chart would suggest that we've got a good chance of that happening. And otherwise, just being content with those kind of quick singles, if that's part of your strategy. If not, you try and find somewhere that trying to find a market that has got that potential for volatility expansion, for range expansion, for that push, for that drive. So keeping that balance, that fine line between those two is a tricky game, but I think it's something that is well worth working on, because a good trade, if it's running for you, it's worth hundreds of small trade. Well, potentially, obviously, financially, it could be, could not be, but it's well worth it, because we get a couple of those and they're running for you as a swing trader, and you're on the end of a trend. If you've got the end of a trend, it's great. It's just a constant thing that's just maturing and making your account more valuable, and just generally improving your trading skill as well. Get a couple of those under your belt. You've got a good year ahead of you. All right, guys, hope you enjoyed the video. Comment in the comment section below. Thumbs up if you like this kind of stuff. Take care. Keep your risk managed. See you in the next one. Goodbye.